Okay, so for sales of goods, right? Okay, with if let's say the normal kind of sale of goods, okay, for example, December the 12th, they sold goods to Jane on credit of a list price of $2,000. These goods cost $750. Okay, such transactions actually have two transactions in one transaction. Okay, so for the first transaction, it relates to the $2,000. Okay, so when you actually sell goods away and it's on credit, okay, Jane actually um promises to pay back the $2,000 to your customer. That means Jane is your customer lah, and she promises to pay you back $2,000. So you own a promise, a trade receivable, Jane, of $2,000. Now this $2,000 comes in as an income as well. Okay, so it's your credit sales revenue, $2,000. Now we try to tackle the cost of these goods. This cost of the goods is $750. Okay, and okay, therefore it's debit cost of sales $750. And because these goods are sold away, okay, so your inventory actually leave your business. Okay, so inventory decreases $750. Now, if we were to open up the different accounts for each of the following transactions, if it is a trade receivable account, Jane, okay, if it increases by 2,000, we'll give you a balance of 2,000 debit, and the particulars will then be the opposite, which is your sales revenue. Okay, meaning to say your trade receivables increases by $2,000, okay, and this constitutes to your sales revenue. Okay, and under sales revenue account, okay, it increases, so it's credit 2,000. You have a 2,000 credit. Okay, and the opposite of this sales revenue, in your double entry, it's your trade receivables. Okay, so it's trade receivables Jane. Meaning to say your sales revenue increased by $2,000, but it is on credit. Okay, so that's why Jane owes you money. Okay, next is we look at the cost of sales. Okay, cost of sales increase. Okay, so it's a debit, $750. Your balance would then be 750 debit. The opposite of this cost of sale is your inventory. Okay, in this transaction, so it's inventory. Last but not least, your inventory account. Okay, if we have followed through all the videos regarding Parker, we have actually bought goods from Parker. Okay, so the above two are actually the transactions in the purchase section. Okay, only the highlighted one relates to this sale of goods. Okay, so your inventory actually decreases by 750. So there's an existing balance of 3,600 debit, minus away 750 will give you 2,850 debit. Okay, and the opposite of this inventory inside this double entry would then be cost of sales. Okay, meaning to say because you decrease this inventory, okay, because of cost of sales.